Moving on to our Did You Know segment, part two. We're talking about home equity and how to tap into it. And today we are talking about home equity lines of credit. So what's a home equity line of credit? I normally try to avoid acronyms because my industry and the real estate industry at large is acronym city. There's so many acronyms for things, but for expediency, I'm going to call it a HELOC. So home equity line of credit, HELOC. You will hear people talk about this a lot. So what is a HELOC? It is a revolving line of credit that is tied to your property as a second mortgage, or if you don't have a mortgage on your property, you can still get a HELOC, and that will be the only mortgage on it. And it works similarly to a credit card. You take out a HELOC on your property, and then you have interest-only payments for a prescribed period of time. Normally, traditional HELOCs are around 10 years. So you have 10 years where you just have to pay the interest on the amount that you borrowed. So let's say you get a HELOC for $100,000 and you only borrow $20,000. You're only going to be paying interest on the $20,000. And then it's up to you to make payments on the principal to reduce the balance that you owe. Some key things to note when it comes to HELOCs. First and foremost, they're variable interest rates. The marketplace is wide, but by and large, there are variable rates tied to these HELOCs. So your monthly payment can change. Depends on how the HELOC is structured. How much equity can you tap into with a HELOC? That will vary from bank to bank, investor to investor. Certain investors that we work with here at Rate will allow you to tap in to up to 75% to 85% of your home's equity. Again, a key note for this, your first mortgage and whatever that balance currently is, when you apply for a HELOC, just like the home equity loan we talked about last week, is taken into consideration when we talk about that tappable equity. So you only have access to the difference between your current mortgage balance and 75 to 85% of what your current home value is. How do we find out what your current home value is? That also varies. Some investors, some banks and lenders will offer HELOCs utilizing something called AVM, automated valuation models. Remember what I said about acronyms? So the automated valuation model allows you and allows us to plug in your property address, and if it's been sold or purchased at any point in the past, normally 10 to 15 years, that data is uploaded somewhere on servers, and there's market data and trends, and that is used to determine what the current value is of the property. So if you have accessibility for an automated valuation model, you may not need an appraisal. They may do a property condition report where they send someone out. They're not looking at the property to assess the value. They're just going to make sure that everything's on the up and up with the property, that the use and habitability of the property is consistent with the requirements. That works fine. The other pathway is getting an actual appraisal report ordered, and an appraiser will visit your home, take a look around, take photos, take measurements, look at comparable sales, and derive your current home value. That will drive how much equity you have that you can tap into. I mentioned there's a draw period. You have 10 years. It's interest only during that draw period. That also means you could take more money out. In my previous example, let's say you have a HELOC for $100,000. You only take out $20,000, and then 2 months later, dishwasher breaks. You got to buy new dishwashers. You tap into that. You take out another $1,000. You can just draw from your HELOC. Take that money out. Now your balance grows. Your interest payment will adjust accordingly, just like on a credit card, and then you'll make your payments. The interest-only period is, like I said, customarily 10 years. After that period, then there's normally a repayment period. So your whatever balance you have on your HELOC at that time, when you reach the end of the 10-year draw period, whatever that balance is, you'll go and you will make fully amortizing payments, and fully amortizing means you're making payment on principal and interest. Meanwhile, the prior 10 years was interest only. So now you have, it can range. It could be 10 to 25 years that you have a repayment phase. It depends on how your HELOC is set up. But then you'll have that, and nothing changes by way of the liens on your property. The lien stays the same, just the functionality of the mortgage payments change. And you'll get notification from your HELOC lender when you reach that point to let you know what your interest rate is for that repayment period, and if you have any options to maybe lock in a rate, lock in a prescribed amount of payment, and pick a repayment term. Common uses for HELOCs: home improvement purposes, if you want to do an update to your property. That's one. Debt consolidation. HELOCs interest rates, because they're variable, they range. And typically, as of my research, right now the marketplace is supporting, HELOCs anywhere from 8.5%. With some recent market volatility we just talked about, maybe it's a little higher. So maybe you're close to 10%, maybe even over 10%. That sounds high. Compare that to your credit card statements. Take a look at those credit card bills and what your interest is on those. Sometimes a HELOC makes sense to consolidate those. Emergency expenses. Something comes up. Now you need to tap into your home equity. Having a HELOC established is a super effective way of getting that taken care of. Think about it this way. If you don't need it, that's the time to get it, so that then this way, when you do need it, you don't have to scramble. College tuition payments. This is something that's become more and more common. People are tapping into their home equity so that they can make payment for tuition. The pros are it gives you flexibility on borrowing. You get interest-only payments, and you may have some tax deductibility. Talk to your accountant on that. The cons are payments can vary and payments can go up. Anytime payments go up, that's risky. So bear that in mind. Interest rates rise over time. That affects what your monthly payment is. And then if you reach a point financially where you're not able to repay, it could start foreclosure, and that presents a risk. Overall, HELOCs are a great option if you want that flexibility, have the financial discipline to pay down the principal on your own. And also, it's a pretty easy process. I will just tag this out by plugging our home equity line of credit, which is a hybrid of these two. We talked last week about home equity loans. Then we talked today about home equity lines of credit. Our HELOC is a fully online experience that you can do online. You can call me, and in about 2.5 minutes on the phone, I can plug in some information and let you know an initial proposal of what your HELOC could look like, and then send you over those options for you to select. And our funding happens normally within about 10 days. So it's a super fast process. Where we differ is our HELOC is actually fixed rate, fully amortizing, but you have a draw period. So even though your monthly payment's based on fully amortizing principal and interest, if let's say you make a lump sum payment, you may have the ability to have your monthly payment reamortized, and or you do have the ability in your draw period to take more money out if another need arises. So that's something that's a little different, because what we offer is a bit of a hybrid. And then I do have other channels that I work through to get you traditional home equity lines of credit. So it's good to know what all of the options are that are available to you.